Hey guys, this is Mike Agnew, CTA Manager of Magna Libra Capital Advisors, home of the Blue Dragon Global Macro Discretionary CTA program. Also, I'm the author of Econemotions.com, a financial and economic blog where we try to post each and every week about the things that we think matter in the economic and trading world. Last few weeks we talked about S&P and share buybacks, as well as the total gross issuance, as you can see down here, negative 700 billion, which will add to the price over the equity in terms of PE ratios, price appreciation as we eliminate the shares outstanding and juice up the stock prices in that format. We also talked about Deutsche Bank, the systemic risk that they present in terms of the global investment banks, and it's far-reaching and wide. And you can see here, this little number right here is 301 billion. That's what the trading liabilities and the cash flow that would be necessary to be, for them to come up with if they closed out these positions. So we know their net derivatives position is probably closer to this 300 billion, not the 48 trillion that you'll see tossed around the internet. Nevertheless, a non-trivial sum here at 301 billion. So let's just be cognizant of that going forward, as this is if this was the old days without the central banks just printing money at will, this would have had a greater systemic effect, and these equity markets would have definitely gotten hit. We're also utilize Capital Trading Group as our introducing broker. We're going to try to partner with them each and every week to bring you this little video update of the things that we think matter for the given week. So what do we see this week? Let's move over to Zero Hedge. We'll check out this little headline: foreigners dump U.S. Treasuries, liquidate a record 216 billion in U.S. stocks in 13 consecutive months. So if we go down here, we can see the foreign flows in and out of U.S. stocks, 12-month moving average. And we feel that this is not that they wanted to sell, but that they needed to sell, because as the central banks around the world trying to keep pace with the weakening fundamentals in the U.S. and their rate hikes earlier this year or late last year has really put the rest of the global economies at risk of faltering. And this is more of not wanting to sell, but having to need to sell the capital raise in terms of foreign participants. So this definitely has been mopped up a little bit by the equity buybacks and by the central banks around the globe that just print money and buy equities, and as the BOJ does and the Swiss National Bank. So this has been backstopped a little bit, but nevertheless this is something we need to keep an eye on. Also here we could see that all the talk of how, if we upset China, they're going to sell our treasuries. Well, we've noticed that they really haven't sold any. But they are down 100 billion over the course of the year, I believe. But that's been mopped up here as the UK certainly went from last year around 220 billion to up to 320 billion. So that 100 billion has basically been mopped up by the UK, and we know Japan will always continue to buy here as well. So buying 37 billion in May alone. So let's not get too crazy about China selling U.S. Treasuries. They can't, and we know it, and we've backed them into a corner. So we'll see. But backing a tiger into the corner probably never ends very well. So we need to keep an eye on the developments there. But we think Trump will continue to press for these tariffs and for them to acquiesce in the future. So we'll see who really has the power. But as we've talked about in length before, Trump never commits to an argument without doing so from the position of power. So let's keep that one on our radar as well. And looking across the globe in terms of our U.S. Treasuries, you can see here the 255 basis points or 2.55 yield that 30-year offers in the U.S. is the highest, only compared to Italy, who's 12 basis points riskier, if you can go figure. And this whole inverted negative yield here, as you see everything in red here is all negative yield, is lowering the overall systematic equilibrium of interest rates. So that means, what does that mean? That means they're dragging the equilibrium level has been decreased below zero. Thus, all global rates will have to follow suit to find equilibrium, whether we like it or not. This is the system that we live in, and it's a system that's in a fiat debt monetary mechanism, fractional reserve lending system. This we can we don't want to allow for this, but the system accounts for this, and it's the only thing we know. But the only we could combat it with cryptocurrencies and a decentralized system, but that's far away. And we can try to combat it by buying real assets, which is why also stock prices go up, because you can't get any yield anywhere else. So it's better to own a tangible asset, even though we know that these asset prices are predicated on printing more and more debt to continue the charade. So but we just wanted to show you this little graphic from Charlie Blello at Pension Partners. You should follow him on at Twitter. That's his handle right there. Puts a lot of good insight out there. So we just wanted to show you this graphic, how the U.S. We always want to talk about too how people always say, well, who wants to buy a bond at 255 basis points? Well, if you look around the globe, well, this is going to look real attractive. So keep that on your mind. We also saw this chart here, the Fang Man market cap. So you put in a quadruple top here. This stopped the markets 1, 2, 3, 4 times, 3 times prior. This is the 4th time. We should probably back away from this a little bit. In terms of market strength. So we'll see what happens. This doesn't present a very good risk-reward ratio in terms of timing of where to get into these things. So we think patience is the rule of the day. So let's not chase this market higher. We also saw this. Let me widen this up a little bit. This from looks like at Sober Look on Twitter as well, also from Deutsche Bank and Bloomberg down here, as you can see, is the source. What this is showing, these risk parity funds, they're beta to global equities. You can see how they're increasingly following and tracing the market higher. That means they're continuing to just go one way, becoming more and more closer to the correlated, being more correlated to the overall market move. Basically, we're all going in the same direction, long only, and this is the boat that everyone seems to be in. But if the tide turns, as you can see what's happened before, time and time again, exit visas are imminent. So there's not too many parachutes to go around. So these risk parity funds are moving into dangerous territory as far as we believe. In terms of risk parity, you can go to Investopedia. They give a great explanation. Right here, it's a portfolio allocation strategy using risk to determine allocations across various components of an investment portfolio. And why is this important? Because everybody's risk tolerances are different. You have your own, I have my own, and everyone else has their own, but all situations are different. So we can construct a portfolio in a 60-40 basic common way, yet everyone's risk tolerances are different and leverage tolerances are different. So let's just listen in here real quick, see what Investopedia has to say. Hey, what do you mean it can't play? Let's refresh that there. What happened?
Risk parity is an investment strategy that focuses on the allocation of risk across a portfolio. Risk parity contrasts traditional allocation strategies that focus on holding certain amounts of investment classes in a portfolio, such as 60% stocks and 40% bonds.
There you go. So you can dig into this. Investopedia does a great job of explaining a lot of different topics, but if you want to check out risk parity and what it really means, you can follow this video for another minute or so and dig in a little bit more, scrolling down and checking that out. Well, what else did we see this week? This little multi-asset volatility index from Real Investment Advisors. You can see basically down here, and this is a conglomerate of the equity vol index, the move index and the bonds, and the dollar index, which is the CVIX volatility index. And the current level is 1.91%, as you can see here, which means that only 1.91% of readings registered at a lower level from here. So what is that telling us? Well, you're taking a lot of risk by saying that the VIX and market sentiment isn't going to turn, and it always does. It tends to spike. I mean, we were up here for quite a bit, but we're at such a low volatility here across all asset classes, as that is proven, and we're taking a lot of risk by not recognizing this fact. So if you don't take any chips off the table here, or at least pull back a little bit, you're kind of being not risk averse enough and being a little bit complacent. So let's just keep this in mind here, and don't be surprised if we turn around in terms of overall long only equity faltering here, because this never stays down here for very long, just so you know. What else did we read today? This came out from Armstrong Economics, and this is on the heels of a Chris Martenson podcast that he did. Here you can see at Peak Prosperity. And for those of you that don't know Marty Armstrong, he's been in the business for a long time, couple decades. A lot of important people listen to him, a lot of important country delegations listen to him, so you should listen to him too. He's a big fan of market cyclical activity. He's a big fan of the 8.6-year cycles, and as here's his economic confidence model here, and his 8.6 wave and pie targets and Fibonacci's. So we're big fans of that as well. So go to ArmstrongEconomics.com and you can read about him and his backstory. It's really interesting and cool. I won't spoil it for you here, but he's got a really interesting background. So check him out. And he also does, and obviously go to chrismartinson.com and check out Peak Prosperity, this podcast that they did there. But also what he does, Marty Armstrong, is, at the Armstrong Economics, is they have a ton of educational resources. And these training manuals, they're about 90 pages here in like this first edition. And it really gives you a nice backbone into how he looks at things and what they look for and how they look at it on a historical perspective, looking back and then looking forward. Elliott waves here, and it is quite a long read, and you want to read it slow and take it all in, but it gives you a good history of how he's looked at things and why he looks at them. So check that out. Also, Macro Voices had on this week Eric Townsend. Macro Voices had on Jeff Snyder from Alhambra, who talked a little bit about the Fed funds rate and the interest rate on excess reserves. And if you don't know what those things are, I suggest you do a little back study on that, because you can really see where the stresses are coming into the markets. And this is really why the Fed started to have a problem, is because the interest on excess reserves started to fall below the effective Fed funds rate, which it shouldn't. It should be above it, because it offers the banks a risk-free arbitrage to make money. But what it doesn't really tell you is that they're not taking advantage of it because they don't want to loan other banks money, because they don't trust the other bank's ability to give it back. What that's really telling you is overall bank systemic risk around the globe is heightened. And I've said it, and we've said it time and time again, lower rates are a sign of higher risk, not the other way around. They are lowering rates because risk is growing, and they need to jump in front of it. But what they don't tell you is that there is so much debt out there and so much, foreign investor appetite for obtaining U.S. dollars, and they're hard to get, but people are paying up for them. So what he talks about a little bit, and you can see here in his chart book here, that here's the effective Fed funds rate in the blue, and it's above this IOER, and then the Fed basically lost control here. They can't control it, but people are saying, look, we don't want to take your risk-free arbitrage. We want to keep our capital inside of our bank because we don't trust the other banks. And, in reality, this global Eurodollar system is out of the Fed's control. I mean, they can open swap lines in that, but in reality, I don't think they have the capital to combat it. But this is more, you can read more about the U.S. dollar offshore market or the Eurodollar system market, and this is where we'll start to see stresses start to come in around the globe. And that's why really the Federal Reserve, they're raising rates late 2019, really caused the rest of the globe havoc, and the other global central banks. As you can see, we talked about, if you go to Econemotions.com, we talked about how the ECB now is a negative 250 billion debit, and that's basically what they're doing, is they're backstopping the other national central banks. So it's interesting. They're trying to mask it as much as they can, but as the debts grow, it's going to be much tougher to do. So go check out Macro Voices. If you don't listen to Eric Townsend, you should. So go there and read this and follow along on their chart deck. It's very, very insightful. What else do we see? Oh, yeah, the fat finger caused Bitcoin to plunge. Once again, this tether's involved, and there are no fat fingers in this redundancy blockchain market. It's virtually impossible. Everything's run by computers now. There's no more fat fingers. Everything's done on purpose. So this is nothing more than a manipulation. It needs to be investigated because it gives the whole industry a bad name. And it kind of annoys us, and somebody's manipulating Bitcoin, in doing this. But, and these perpetrators need to be put in their place, because it gives the whole industry a bad name, where we're big fans of blockchain and Bitcoin, and things like this don't help the cause. So this is nothing more than manipulation. Don't listen to the fat finger. That's BS. Plain and simple. Impossible. Doesn't exist anymore. But what it did is knock the Bitcoin price down, so straight in, below 10,000 again. But it really, started to sell off from this point here, this 13.6 level here. This was also the 618 of the retracement Fibonacci level from the low to the new high, and now we're back below 10,000 and trading here at 96. So the 618 on the reciprocal side from this high down from the prior low at 3,200 is down to 71.71. So let's be kind of the 71.71 level. If you are involved in Bitcoin, do your research. We like to say it exists everywhere and nowhere. We like to think it's the future. And peer-to-peer, frictionless, immutable, decentralized is the future, but it removes control from the central banks and the power hierarchy. So it's not going to, they're not going to go down without a fight. So expect more regulations. And in fact, let's go see what our fine Secretary of Treasury had to say about Bitcoin just the other day. If this will play. I don't know why it won't. Let's give it a little refresh. See what, oh, darn it. Let's go back. Forbidden. The terrible forbidden. I don't know. Can't get it back. Anyways, go listen to what he said. He said Bitcoin was used mainly for illicit activities and shouldn't be trusted, and God forbid the US dollar isn't used for that, but we all know the US dollar is by far the biggest currency of choice from our cartel laundering individuals. So let's not think too much into Bitcoin in that and blockchain in that respect, but rather that the US dollar is still by far the worst perp around. Okay, let's get to a chart here. Let's go to WTI. Lost ground here at the 60 buck level, which was once again the 618, pretty formidable and pretty powerful, and it's backed off since then. This is the level they need to get above. The IEA put out a report about a possible supply gut going into next year, so that's not helping the cause here, and neither is this formidable $60 level. So keep an eye here. Bulls can't be bullish here up at 60, and if the stocks turn around, we should probably expect this to turn around as well. Silver had a nice breakout move here above 1420, moving above 1465 here, and really breaking out of this nice downward wedge. You can see 15 bucks is probably the nice level that they're going to try and target and get above and really break out, because this is pretty much the standard that everyone's really looking at, and it's been getting beat up against gold, so we expect that ratio and that pair trade to turn around here as silver outperforms. And finally, the NASDAQ bumping up at that 8,000 level once again, took out this top a little bit, running into a little of a trend line here. A moving average here, 21-day moving average, and if we get a break below the 79.47, we can probably bet that 78.10 is not going to be too far behind, but the real bigger level below, there's a 382 at 76.08. So keep an eye here. Equity indexes, not a big fan here up at these lofty levels, but it's been a one-way trade for a long time. But like we said, lower rates are a sign of higher risk, and those VIX down at that 1.91 level that we showed here. Where is it? No, where is that? What the heck? Here we go. This one. This should be on everyone's mind. You want to keep long and getting longer, or you want to take some chips off the table? Your choice. Anyways, that's it, guys. We'll talk to you next week. Cheers.